Today on Watching Your Wealth, how some of President Trump's policies could impact your taxes.
This is Watching Your Wealth from the Wall Street Journal. Now, from our studios in New York, here's Veronica Dagger.
This is Veronica Dagger, and you're listening to Watching Your Wealth, while you learn all you need to know about building your wealth and protecting your money. Ed Slott is a retirement expert and founder of Ed Slott and Company. Welcome back, Ed.
Great to be here. Thanks.
Great. So there's still a lot of uncertainty about the fine details and even fate of President Trump's tax proposals. That said, we know he generally wants to lower taxes for individuals and corporations. So how can we use that knowledge to our advantage?
Well, you already have the advantage because taxes are already great again. We're in the lowest tax rates you'll probably ever see if nothing was done. That's why now is the time to strike. You really have to have a little history behind you. Remember, in the late 70s into the early 80s, the top federal tax rate was 90. That's 90%.
In the United States,
then it
yikes.
went down to 70%.
Oh,
and then in the early 80s, it went down to 50%. And I remember that time the whole country did a happy dance that the top rate was down to 50%. In other words, everyone was thrilled that the government was 50-50 partners with us on our own money, and we thought that was fantastic given where we came from. Now the top rates are even lower, and they have been. And if anything, according to the proposals, tax rates may go even lower. But there's a core principle. You know, when we talk about investing in taxes, people always say generally, maybe, a lot of weasel words, because check your facts and circumstances.
Exactly.
But here's an always rule. A core of tax planning is always pay taxes at the lowest rates. But that's like saying always buy low and sell high, right, and always get the best lottery tickets. But with taxes, you really can count on the lowest rates, I believe, now. And if anything, they might go lower. So now, and I'm talking about 2017, rates are already low, but they may go lower. So now is the time to strike. Here's what I mean.
That. Yeah, so let's talk about some sort of specific tips. Like, what steps should we take now? How can we strike, given the uncertainty, but given the current tax environment?
Well, many people have most of their money tied up in tax-deferred accounts. That's your 401ks and IRAs. This is money many retirees or soon-to-be retiree or savers have tied up in money they work for most of their working lives that will put away in tax-deferred. Now, that's the key. Tax-deferred means that money hasn't been taxed yet. Now, many people have gotten deductions at higher rates. Now it might be the time to pull it out, even if you're not ready for retirement. Remember, back to the rule, always pay taxes at the lowest rates. If you could get some of that out now, and it's not an all or nothing, this is one where you do have to look at your own situation, but it might pay, for example, to do a Roth conversion or do part of it. Doesn't have to be an all or nothing, but to get that money and move it to tax-free territory while the rates are at, I believe, rock bottom and may only go lower. This way, you've moved money from a account growing tax that will be taxed soon. That's what tax-deferred is. It's not being taxed while it's in the IRA or 401k, but it will be taxed at some point. That tax will have to be paid. I'm saying pay it when the rates are the lowest because history, Mark Twain had this saying, history doesn't repeat itself, but it rhymes. We can see rates go back up in many years, and it may even be a short amount of years when some of these bills come due. You know, you just can't keep putting everything on a credit card. At some point, they're going to have to raise taxes again. So this may be the time to strike, to get some of that taxable money out, move it into tax-free territory where you remove the uncertainty of what future tax rates or higher taxes could do to your retirement savings.
Indeed. What advice do you have for couples? Because we may have this repeal of AMT.
Yeah. Again, that would lower taxes. That would lower the amount, that would increase the amount you take home. So again, with the Roth conversion, that would even make that Roth conversion even more valuable. But it would make deductions more valuable too. In fact, many people don't even get the deductions they think they get. They put in all these, say, work-related expenses in their tax return, or they deduct huge state taxes if you're in a high-tax state like New York, and you don't even get the benefit of those deductions. If that AMT was repealed, many people subject to it, and more people are subject to it, would have more money to spend because the taxes would be lower for those people.
Okay, I'm sure this could be an exciting time for some savers and some investors.
The point is to take advantage of it, not just sit around and watch the news being made. So you could move money out of these tax-deferred accounts. You could even move money into, look at tax-free vehicles. I like the idea of removing the tax where you never have to worry how high taxes might go in the future. So Roth IRA is one of the great tax shelters of all time because whatever you put in a Roth IRA, yes, you have to pay tax to get the money in there, but if you can buy taxes on sale, which is really what we're talking about now, and that's different from a sale in the store. With a sale in the store, you don't actually have to buy the item you're looking to buy. With taxes, you're going to pay that bill. It's just a matter of when. So as long as you have to pay it anyway, may as well pay it on sale and move it to tax-free vehicles like Roth IRAs or even permanent life insurance. Most people don't think about that as a savings account, but that can double as a retirement savings account. The whole point is, I always like to say, you're moving your money from accounts that are forever taxed to accounts that are never taxed. So you never have to worry going into retirement. The last thing you want to worry about is tax rates going up to 30, 40, 50% or higher, just when you need the money most, when the paychecks stop and you're the most vulnerable. That's the time you don't want to have to worry about what tax rates are.
Indeed.
With the Roth IRA or with the life insurance or other tax-free vehicles, you end up at a 0% rate. In other words, all the gains, all the earnings, you keep 100% of. That's where you want to be, and now would be the time to do that, taking advantage of unusually low, historically low rates that may even go lower.
Ed, I love your enthusiasm. We need to take a quick break, but when we come back, I want to hear more of your tax tips.
Okay.
Hi, I'm Paul Vigna. If you do not subscribe to the Money Beat podcast, you are going to feel worse than a short seller on the day of a big rally. Go to iTunes and WSJ.com/podcasts. You want to sign up for this one.
WSJ Podcasts. Listen ambitiously. This is Watching Your Wealth from the Wall Street Journal. Now, from our studios in New York, here's Veronica Dagger.
Welcome back to Watching Your Wealth. Retirement expert Ed Slott is giving us some tax tips. So, Ed, if we're already retired and taking our required minimum distribution from our IRA, is there anything we should be doing in this environment?
Well, again, once you hit, say, that magic age, 70 and a half, you have to take that money and pay the tax. So for people before that, some of the planning might be to take that money out before you hit 70 and a half. One of the things you can't do once you have required minimum distributions is convert those required minimum distributions to a Roth IRA. But you could use that money to convert other money. In other words, the required amount has to be taken out. You can't convert that. But once you convert that, you may want to look, once you take that money out, in other words, the RMD you cannot convert. Once you take that out, you could convert additional funds to a Roth and start moving that into tax-free territory. Also, with people who are subject to required minimum distributions, RMDs, I've been calling them, they have an advantage at 70 and a half to make direct transfers to charity, something called qualified charitable distributions. It's only available for IRA owners who are 70 and a half or older. But the great thing about that is, and you might be listening to this and saying, well, maybe I don't want to give to charity. Everybody gives to charity, or at least that's what they say on their tax returns anyway. I never saw a tax return where somebody said, I don't give anything. Everybody gives something. So if you make contributions anyway to any qualified charity, do it directly through your IRA, and it'll cut your tax bill. You'll almost always end up in a better situation because it satisfies your RMD up until the amount you give. And there's a limit, but it's a very high limit. You can do up to $100,000 of that per person per year. But let's say your required minimum distribution is $5,000, and you normally give $5,000 to charity. Make a direct transfer. It's called a charitable rollover or a qualified charitable distribution from your IRA to the charity, and you don't have to include the $5,000 in income.
Great
and
tip.
It satisfies your required amount. Now, on the other end, you don't get a charitable deduction, so it might sound like a wash. But anytime you lower your income by excluding that RMD amount, what happens is your deductions get increased. Many times people lose deductions because as your income increases, the certain deductions, exemptions, credits, basically anything good on a tax return starts to phase out as your income increases. This is a way to keep income low in retirement.
Great tip. Thank you so much for joining us, Ed. We appreciate it.
Great.
And do you have a personal finance question you'd like us to answer? Email us at podcast@dowjones.com. This has been Watching Your Wealth, a production of the Wall Street Journal. I'm Veronica Dagger. For more information, check us out at WSJ.com/podcasts. Thanks for listening.
For more podcasts, check us out at WSJ.com/podcasts. Become a subscriber on iTunes, Stitcher, Spotify, and now look for us on the Google Play Music app on Android devices.